According to a survey done by BNN Bloomberg and rates.ca, a third of Canadians do not understand how higher interest rates are going to affect your mortgage. So in today's video, I'm going to show you exactly how much certain types of interest rate increases will affect your mortgage and how to calculate this for yourself. The definitive guide on how to manage your credit. Product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so welcome back. Today we're discussing how much an increase in interest rates would affect your mortgage because apparently, according to BNN Bloomberg, a third of people don't understand exactly how this would affect them. So we are going to go through and discuss exactly how much an interest rate increase would affect you and show you exactly how to calculate the numbers for yourself so that you can plan for the future in the event that interest rates do start to go up. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers, where one lucky subscriber is going to win $5,000 to pay down their debt, put towards their down payment, or simply do with whatever they like. But in order to win, you have to be subscribed. So go ahead, click that subscribe button. It's free, it's easy, and it's definitely worth it. So before we get started, I want to point out first and foremost that everything I'm going to talk about today, all the calculations and all of that, you can do for yourself by downloading our My Mortgage Toolbox app and basically plug all the numbers in and do this on your own for your own mortgage type. I'm going to use really simple numbers, $500,000 mortgage, simple interest rates, so on and so forth, and 25-year amortizations. So this should be really simple calculations. But before I get into the actual details there, I want to show you real quick. This is the article coming out of BNN Bloomberg, 29% of mortgage holders unclear on impact of higher interest rates, and basically how that will affect them going forward. So this is not unsurprising. I think there's a large portion of people who are clear on how higher interest rates are going to impact their mortgages based on the fact that they have 5-year fixed. They're clear. But there's a little bit of planning that needs to be done for those of you who have 5-year fixed mortgages as well, because this low rate runway thing, if interest rates do start going up, is going to have an effect on you at some point as well. And I'm going to talk about a little bit about that in a second. So let's jump in here to the app real quick. I'm going to split off my screen and show you our My Mortgage Toolbox app, where you can go in and you can calculate these numbers for yourself. Now, first and foremost, we're going to run based on the assumption that most people are taking variable rates, because most people who watch this channel choose variable interest rates, largely because they're at such a discount to their fixed rate counterparts. Now, that being said, if you do have a 5-year fixed rate, you need to do some planning, because here's what's going to happen. If interest rates do go up, and if it is as worrisome as some people would have you believe, like Derek Holt at Scotiabank, and they do go up by 2%, you're actually going to have to do some planning and expect that at the end of your 5-year term, you're going to see a 2% increase in interest rates and therefore a significant jump in your payments. It's what we call payment shock. When somebody has a 5-year fix, they haven't been paying any attention to interest rates, and then all of a sudden, overnight, their payments change because they had to renew into a higher interest rate mortgage. So you want to be planning for higher interest rates regardless of if you have a variable or if you have a fixed rate mortgage. Now, it's my belief that when you pay for a fixed rate mortgage, you pay more upfront in the form of a rate premium by paying a higher interest rate. You pay more for penalties to get out of them. The payout penalties are significantly higher than what they would be on a variable interest rate. And more often than not, you're basically paying for insurance against higher interest rates. So this tool, if you're in the process of selecting your mortgage, is going to help you see the difference in a dollars perspective of what a variable versus a fixed cost. Because when you start to look at things in a dollars perspective rather than an interest rate perspective, it actually creates some context for what you're actually thinking about and what you're considering. Because, when we talk about interest rates can be confusing. People are always sitting there, texting us, calling us, going, hey, what's the best rate you can get? I'm trying to get 0.05% lower than what my bank offered me. It's like really what they're chasing is a cup of coffee a week. And at the end of the day, that cup of coffee a week matters far less than the features, the actual product itself, the ability to pay down the mortgage, and most importantly, the penalty. But they know that they're supposed to try to get a lower interest rate, so they chase around for that cup of coffee a week and don't realize that it's only $3 or $4 a week that they're chasing after. So what I want to show you when we start talking about variable versus fixed rates is what the dollar difference is between the product that you're getting from a 5-year fixed versus a variable and how much difference that is per year. So let's start by doing that. Let's start by looking at variable versus fixed right now. Let's say you can get a variable rate for 1.15%. and you can get a fixed rate for 2.15%. Now this is on a $500,000 mortgage. So all we're gonna do is we're gonna take the 1.15% and we're just going to scale that up to 2.15% because it's actually a 0.15%. I have to go in and type it in here. What you can see is that the payment goes up to $2,155. Now, just to go back and show you what it was before, previously it was $1,918. So this is about a $240 difference in the actual cost of the mortgage on a monthly basis. Now take that $240, go into your calculator app, go like this, and go, okay, well, that's times 12. That's your difference in the interest on a fixed versus a variable for the year. So it's about $3,000 more expensive to have a fixed rate than a variable, at least from a payment perspective, when you have that 1% difference in interest rates. Now, obviously, the interest cost is actually more than that. And the reason why is because when you calculate in and factor in amortization, it skews the numbers with respect to principal and interest. Now, let's just jump back into here and take a look again at our payments. Now, the first thing, if you understand that it's going to be basically $240 difference in your payments every single month, and it's going to take 4 interest rate increases before you're basically at the exact same interest rate. Well, most people will then go and establish for themselves whether paying $240 per month more is worth it in order to have that protection just in case interest rates go up more than 4 times. Maybe they go up 8 times. Now, here's the question though. What does the payment difference look like at different increments of increases in payments? Because what we have is we have the Manulife economists, for example, who are saying that you should probably expect 2 interest rate increases over the next 2 years. Then you've got Derek Holt of Scotiabank. He's on the other side of the equation. He's saying 8. So let's take a look at what that would look like based on different increases in interest rates. So let's start by increasing interest rates by 0.5%. So we're going to go from 1.2 to 1.7. So here we are, $1,929. If we go to a 0.5% increase, it basically increases the payment by $120. So we know that a 0.5% increase for a $500,000 mortgage is going to increase our payment by $120, and we're going to have to account for that in our budget. Now, let's say it goes up by 1% to 2.2%. Well, now we are at $2,168 per month. So then what you have to figure out is the difference in the payments and whether or not you'd be comfortable with that payment if interest rates did go up by 1%. Now let's go up to the Derek Holt number, which is a 2% increase over the next 2 years. That puts our payment at $2,423, almost $500 more than what it would be when we started. So a 2% increase in interest rates, the worst case scenario as predicted by economists on today, indicates that you would have about a $500 increase in payments if interest rates were to go up that much. So then from there, you have to make that decision of, okay, well, I could get an interest rate of 2.15 or 2.2% on a 5-year fixed. It's going to cost me $240 more for the next however long it is until interest rates go up. And then you make your decision whether that $240 is worth it from basically an insurance perspective, a self-insurance perspective. Now, no matter what you do, no matter what you decide, keep in mind that you have been qualifying, if you got a mortgage in the last 5 years, at pretty close to 5%. So here's about the payment, $2,864, that most people have been qualifying at on a $500,000 mortgage, because the Bank of Canada has what they call the benchmark rate. And that benchmark rate is designed to make sure that you can qualify for a significantly higher interest rate than what you're actually borrowing at. So therefore you can withstand any sort of increases in interest rates. This is a product of 2008, 2009, and the financial crisis, and the time that followed, where it seemed like interest rates were going to go up substantially over a very short period of time. By the way, we've had this conversation before, and that's why the Bank of Canada and the federal government have put this measure in place to make sure that you're qualifying at a higher interest rate in order to make sure that you can weather a higher interest rate storm. So keep that in mind when you're looking at your mortgages. You're already qualifying at essentially a 50% higher payment than what you're actually getting. So you should be able to, in a normal market and in a normal scenario, withstand any sort of interest rate increases. Now, you may have to reduce your consumption of other goods and make sure you're not spending as much. But for the most part, the debt servicing ratios, which is the percentage of your income that can go to making your mortgage payment, has been calculated for quite some time off a significantly higher interest rate than what you're actually paying. So here's the thing though, because people who have a 5-year fix, they go, well, I've got my 5-year fixed. I know I'm good for at 2.2%. Well, what happens if interest rates do go up by 2%? Well, you're going to have to account for the fact that you're probably going to have some sort of a payment shock between now and when you actually come up for renewal, and that your payments could go up quite considerably. So here's what I recommend you do, regardless of whether you have a 5-year fixed mortgage or a 5-year variable. What I recommend that you do is you go and you figure out, based off of the benchmark rate, or if you're taking a variable, off of the 5-year fixed rate, or off of some rate that you predict interest rates are going to go up. Say it's 1% or 1.5% or 2%. And what I would do is I would figure out what your payment would be if they were to go up to that amount. And then what I would do is I would start taking the difference between that higher interest rate payment that you calculate and what you're paying now, and start taking it and shuttling it into some sort of investment account, probably a TFSA. There's a link in the description below for Quest Trade, where you can trade ETFs basically for free. At least you can buy them for free. Go ahead, set up a TFSA, and start automatically siphoning off that difference in the hypothetical payment and the payment you're actually paying into an investment account, so that in the end, if interest rates do go up, you're protected. And here's the big thing, right? Is people who are in a 5-year fix think they're protected for 5 years. I believe you're significantly better protected if you take a variable rate and you take the cash and start setting it aside, because if interest rates don't go up, you're going to get all the benefits of the variable interest rate, but you're also going to have that cash that's available to you in the event that interest rates do go up. And if they don't, then it's a bonus. You get to keep that money. You have an investment, and you end up being significantly better off 5 years down the road, because you took advantage of basically a little bit of interest rate arbitrage. You took the lower interest rate while you had the opportunity. You set money aside, you saved, and ultimately, if you invested it as well, you end up growing that money and end up in a significantly better position than paying a higher interest rate to the bank for a false sense of security, and potentially for a significantly higher payment in the event that you need to get out of the property. Because that's the other thing you got to think about with 5-year fix. You almost always have a big penalty. And quite often, even when interest rates are going up, you can have a high penalty if you have a big bank 5-year fixed. So you need to keep that in mind as well, is the variable rate has that significantly more flexible opportunity with respect to if you end up having a situation where you need to sell, you want to get out of the mortgage, you want to refinance because you need to get cash out because something went wrong. And in my books, flexibility is everything when it comes to a mortgage. I'd much rather have a flexible mortgage that I pay less on and have some strategy around saving than have something that seems more secure but more expensive to get rid of and is an avenue to give a whole bunch of my equity back to the bank in the form of a penalty. So that is basically it. I recommend that everybody goes, calculates out what their payments would be if they increase by 1%, 2%, even 3%. Figure out a strategy so you have money being put away in case that happens. And if you have cash on hand, remember, cash is king. Having that cash on hand will make you significantly more secure than any other option or any other thing that you could possibly do when it comes to selecting your mortgage. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. Don't forget about our race to 25,000 subscribers, and we'll see you on the very next one. Cheers.